Good day, everyone. Today, we will be discussing a commonly used valuation metric in fundamental analysis, which is the price-to-earnings (P/E) ratio. We will use company ABC, a publicly traded company that manufactures and sells shoes, as an example to help us better understand how to calculate and interpret the P/E ratio. First, let's look at the basics of calculating the P/E ratio. To calculate the P/E ratio for company ABC, we simply divide the current stock price by its earnings per share, EPS, over the past year. If the stock price is $50 per share and the EPS is $5, the P/E ratio would be 10. What does this mean? It means that for every dollar of earnings per share, investors are willing to pay $10. The P/E ratio is a crucial metric for investors because it helps them evaluate the price of a company's stock relative to its earnings. A high P/E ratio may indicate that investors are optimistic about the company's future earnings growth, while a low P/E ratio may indicate that investors are not expecting much growth or are concerned about the company's future prospects. However, it's important to note that the P/E ratio should be used in conjunction with other financial ratios and analysis to make an informed investment decision. Additionally, the P/E ratio can be used to compare the valuations of different companies in the same industry, or to track a company's valuation over time. When comparing the P/E ratios of different companies, it's essential to compare companies with similar business models and financial performance. In conclusion, the P/E ratio is a valuable tool for investors in company ABC to evaluate the price of a company's stock relative to its earnings. It can provide insight into the market's expectations for future growth and profitability, but it should be used in conjunction with other financial ratios and analysis to make informed investment decisions. Thank you for listening, and we hope you find this information useful.